Welcome to this deep dive. We're tackling one of the core financial statements today, the statement of cash flows. We've got a stack of sources here, everything from the basic definitions right up to detailed accounting guidance.
Yeah, it's the one that sometimes feels a bit like the forgotten statement, doesn't it? People focus on profit, on assets, but cash flow tells a really different, absolutely critical story.
That's exactly right. Our mission here is to kind of cut through that technical jargon. We want to uncover the essentials you need from these sources to really understand where a company's cash actually comes from and where it goes.
It gives you a different perspective for sure, maybe a more revealing one sometimes, compared to just the income statement or balance sheet.
Totally. Think of it as mapping the financial bloodstream, maybe. Profit's one thing, assets another, but cash is, well, it's the lifeblood, right? It lets the company operate, invest, pay its debts.
Couldn't have said it better.
Okay, so let's unpack this. Before we can even track the flow, we need to know what we mean by cash. Seems simple, but what do the sources say?
Well, on the surface, it's pretty straightforward. Cash on hand, demand deposits, your basic checking accounts, money you can grab right away.
Right, but then there's this other piece, cash equivalents. That seems really important.
Oh, absolutely crucial. Because they get lumped in with cash on the statement. These are things that aren't strictly cash, but they're, like, super close.
So what makes something close enough? What are the key traits?
The sources are quite clear on this. They've got to be short-term, first off, highly liquid, and, critically, readily convertible into a known amount of cash. No guesswork involved.
Okay, known amount. And there's a time limit too, isn't there?
Right.
Something about maturity.
Exactly. They have to be very close to their maturity date, so the risk of their value changing significantly is minimal. The usual benchmark the sources point to is 3 months or less.
3 months from issue.
Good question. No, it's typically 3 months or less from the date the company acquired the investment. That detail really matters.
Got it. So a T-bill bought 2 months before it matures would count, for example.
Precisely. Money market funds can also fit, provided they meet certain conditions, like having a stable share price, that sort of thing.
Okay, so we've got cash plus these very stable, very short-term things treated as cash. That's the pool we're watching. But what about restricted cash? Money the company has but can't quite use freely.
Yeah, that's a great point, and actually something accounting standards ASU 2016-18 specifically clarified not too long ago. Restricted cash money may be held in escrow or required by a lender to be set aside. That generally gets included with cash and cash equivalents on the balance sheet now.
Included. Okay. And how does that play out on the cash flow statement itself?
Well, the statement needs to explain the change during the period in the total of cash, cash equivalents, and restricted cash. So you reconcile the beginning total balance to the ending total balance.
Why is showing that total reconciliation, including the restricted part, so important?
It gives you the full picture. You see all the cash the company manages, even the bits it can't immediately spend on anything. It avoids confusion if, say, a big chunk of cash moved into a restricted account. You see the whole universe of cash changing, not just the spendable part.
Okay, that makes sense. Full transparency. So we know what counts as cash. Now the main event, tracking the movement. The core idea is splitting all cash movements into 3 big buckets, right?
That's the heart of it. 3 main types of activities that generate or use cash. And the classification, this is key, it's based on the nature of the activity itself.
All right, let's dig into the first one. Operating activities. This feels like the engine room.
It really is. These are the cash flows from the company's main business, whatever it does to generate revenue. Selling goods, providing services. The sources say these generally tie back to the transactions that determine net income.
And companies can show this section in 2 different ways.
Correct. There's the direct method, which honestly is very intuitive. It shows actual cash collected from customers, actual cash paid out to suppliers, to employees, for interest, for taxes. You see the gross amounts flowing in and out.
Sounds really useful. But we don't see that often, do we? The indirect method seems much more common.
It is, certainly in the U.S. The indirect method starts with net income, the bottom line from the income statement, and then it works backward, essentially. It adjusts that net income figure for all the things that affected profit but didn't actually involve cash moving.
Like depreciation.
Exactly. Depreciation, amortization, gains or losses on selling assets, changes in working capital accounts like receivables or inventory. You add back non-cash expenses and subtract non-cash income.
So you're basically reconciling the accrual-based net income back to the cash-based flow from operations.
Precisely. And while the presentation looks totally different, both the direct and indirect methods must arrive at the exact same final number for net cash flow from operating activities.
Okay. And examples would be cash from sales, payments for inventory, salaries, interest received that's operating.
Yep, interest received is typically operating. Same with income taxes paid. It's all tied to the main business operations.
All right, so that's the day-to-day business cash. What about cash used for, say, building the future of the company, long-term stuff?
That leads us straight into the second category, investing activities. This is all about acquiring and disposing of long-term assets and other investments that aren't cash equivalents.
So buying a new factory or selling off old equipment.
Absolutely. Purchases or sales of property, plant, and equipment, PPE, are classic investing activities. Also, buying or selling stocks or bonds of other companies falls here unless they're those cash equivalents we talked about or specifically held for trading purposes, which then usually loops back to operating.
What about making loans?
If the company makes a loan to another party, the cash going out is investing. When they collect the principal back, that's also investing. It's about investing the company's capital outside its core operations.
Got it. Building, buying, selling long-term assets. Okay, third bucket.
Financing activities. This is all about how the company funds itself and how it returns capital to its owners or repays its lenders. It relates to changes in the company's debt and equity structure.
So taking out a bank loan.
That's a financing inflow, yes. Issuing bonds, same thing. And then repaying the principal amount of that debt is a financing outflow.
And issuing stock.
Issuing the company's own stock brings cash in financing inflow. Buying back its own stock, treasury stock purchases, that uses cash financing outflow. And a big one, paying dividends to shareholders. That's a financing outflow too.
Okay, principal payments on capital leases too, you mentioned.
Yes, those are also considered financing activities.
So operating, investing, financing, seems like that covers everything. Or are there wrinkles?
Oh, there are always wrinkles in accounting. While the categories seem clear, our sources definitely highlight that classifying certain transactions takes judgment and isn't always obvious.
And you also mentioned things that don't involve cash immediately, but are still important.
Exactly. Non-cash investing and financing activities. These are significant transactions, but without a direct cash impact in that period. Think about buying a building and financing it entirely by taking out a mortgage from the seller. We got an asset, you took on debt, but no cash changed hands then.
So they don't go in the main statement.
Correct, because there was no cash flow. But they're too important to ignore. Accounting rules say you must disclose these significant non-cash transactions separately, usually down in the footnotes.
Okay, that preserves the integrity of the statement, focusing purely on cash movements, but still gives you the full story. Makes sense. What if one transaction seems to have elements of, say, both investing and financing?
Yeah, that can happen. The sources talk about potentially needing to split the transaction, bifurcation, they call it, or you might classify the whole thing based on which aspect is considered the predominant activity.
Predominant. How do you figure that out? That sounds like judgment territory again.
It definitely is. You have to look at the substance. What's the main purpose here? Is it primarily about acquiring an operational asset, investing? Is it mostly about raising funds, financing? It requires analyzing the specifics.
Okay, let's get in some of those specific, tricky examples you pulled from the sources. What about when a company sells its receivables, gets cash up front from a finance company? Is that operating cash because it relates to customers, or is it financing like a loan?
This one really trips people up sometimes. The sources describe scenarios, often involving things like securitization conduits, where it's treated as financing. The cash the company gets from the financing company is a financing inflow.
Okay, like borrowing.
Right. But then, and this is the counterintuitive part, when the company collects the cash from the original customer and sends it over to the financing company, that payment out is classified as an operating outflow.
Whoa, so the collection from the customer, which feels fundamentally operating, becomes an operating outflow in that structure.
Yeah, it can seem backward, but it reflects the structure of the deal. The cash received was financing, so the repayment related to that financing, even though sourced from customer collections, flows out through operating activities as the receivable is effectively settled with the conduit. It shows how structure really dictates classification.
That's a fascinating example. What about distributions from investments accounted for under the equity method? You get cash from an investee. Is that a return on your investment or a return of your investment?
Another great question. ASU 2016-15 gave guidance here. The general idea is to compare the distributions received to the cumulative earnings recognized from that investment. If the distributions are less than or equal to those cumulative earnings, they're typically seen as a return on investment.
And that would be
Operating. Often, yes, treated as an operating inflow, similar to receiving dividends normally. But if the distributions exceed those cumulative earnings recognized since you invested, that excess portion is generally viewed as a liquidating dividend, a return of your original investment.
which would make it investing.
Exactly, an investing inflow. So you might even have to split a single distribution payment between operating and investing classifications based on this cumulative earnings threshold.
Wow, okay. Requires careful tracking. Derivatives must be complex too.
Definitely. For derivatives, the classification of cash flows generally follows whatever the derivative is hedging or linked to.
Hmm.
If it's hedging, say, the price of inventory purchases, that's operating risk, so the cash settlements are operating.
Okay.
If it's hedging the interest rate on debt, that's related to financing, so cash flows are financing. If it hedges the foreign currency value of an investment in a subsidiary, that relates to investing, so cash flows are investing. You trace it back.
And even basic debt isn't always simple, like interest versus principal or fees.
Right. Principal payments are financing outflows, but the cash paid for interest is typically an operating outflow. Costs paid to lenders when you issue debt, those are usually financing outflows. Things like zero coupon debt, where interest isn't paid currently but is baked into the discount, also need careful handling to reflect the substance.
It really sounds like the devil's in the details for classification once you get beyond the straightforward stuff.
Absolutely. Judgment, understanding the substance of the transaction, and knowing the specific guidance are all key. And then there's foreign currency.
Right. If a company operates internationally, how does that work?
You have cash flows happening in various currencies. Generally, you translate those into the company's reporting currency using the exchange rate in effect at the time of the cash flow. Though, for practicality, average rates are often acceptable for high-volume operating flows.
But exchange rates fluctuate constantly.
Yeah.
Won't that create a difference between the cash flows reported and the change in the cash balance on the balance sheet just due to rate movements?
Precisely. And that's handled quite elegantly, actually. The statement includes a separate line item, usually towards the bottom, showing the net effect of exchange rate changes on the cash balance. It's basically a reconciling item that bridges the gap.
So it isolates the impact of currency fluctuations from the actual operating, investing, and financing flows.
Exactly. And one more thing on segregation. If a company sells off a whole segment, a discontinued operation,
Yeah.
the cash flows related to that operation need to be shown separately. Even within the operating, investing, and financing sections, you'd see lines for continuing ops and lines for discontinued ops. Gives a clearer picture of the ongoing business.
Phew. Okay, we've gone through the building blocks, the main categories, and waded into some pretty complex territory there with classifications.
Yeah.
Let's pull back a bit. For someone listening, why does getting a handle on all this matter? What's the payoff?
The payoff is huge, really. The statement of cash flows gives you a perspective on a company's health and activities that you simply cannot get anywhere else. Not from the income statement, not from the balance sheet alone.
It's about reality versus accounting rules sometimes, isn't it? Like, are the profits showing up as actual cash?
That's a big part of it. Is the company generating enough cash from its core operations to sustain itself, to invest, to pay its debts, or is it burning through cash? How is it funding its investments internally, or by constantly borrowing or issuing stock?
So you look at the three sections together. Positive operating flow. Maybe negative investing if they're growing. And then financing tells you how they're funding that investment, or if they're paying down debt or returning cash to shareholders.
Exactly. It paints a dynamic picture. Consistent, strong operating cash flow is usually a very healthy sign. Heavy investing outflows might mean growth, but you need to see how it's financed. Large financing inflows could mean they're raising needed capital, or maybe they're struggling to fund operations internally. Large financing outflows could mean paying down debt or rewarding shareholders.
It gives you a lens on liquidity, solvency, financial flexibility, way beyond just the net income number. It's where the rubber meets the road, you could say.
Well put. It shows the actual movement of the money, which is fundamental. It complements the other statements perfectly.
So this deep dive, we've covered the fundamentals, what cash is, the three big activities, and some of those tricky classification areas that the sources highlight.
Yeah, understanding how that cash moves sorted into operating, investing, and financing is just such a powerful tool for assessment.
Okay, let's wrap up with a final thought for you, the listener. Something to chew on. Given how much judgment seems to be involved in classifying some of those more complex things we talked about, like derivatives or those receivable sales structures, how might a company's accounting policy choices in those gray areas potentially shape the story that their statement of cash flows is telling?
And building on that, if you were digging into a company's financials, what might you look for beyond the numbers on the face of the cash flow statement itself, maybe in the footnotes or management discussion, to get more comfortable with how they've classified things and the overall picture it presents?